Hey guys, hope everyone's doing well. Today I want to introduce you to a new series I'm going to be uploading called the ICT model series. Okay, and pretty much I'm just going to be posting models in my Discord here, which I'll post a link to in the description. And I'm just going to be going over and breaking down models for you guys, okay, in all of this. So, starting off, I want to go through the regular trading hour and first presented fair value gap model, okay? So let's just honestly jump right into it. I'm just going to start off and go over the overview of the model. So this model is specifically designed for US index futures, NASDAQ, ES, Dow Jones. Time window for this model is 9:30 a.m. to 10 a.m. What is the opening range gap model? The opening range gap model is an intraday trading setup taught by ICT that focuses on the price gap between the previous day's close and the current day's open. This acts as a liquidity zone and a sentiment filter. This model looks for a directional bias before 9:30 a.m., a retracement into the gap after the open, a valid time-based fair value gap for entry, a mechanical stop loss. Okay. Everything in this model is based around exact and specific time-based levels, leaving no room for thinking and emotion, just complete mechanical trading, perfect for beginners. So don't worry if all of this doesn't make sense right now. We're going to go through it and break it down, okay? So model criteria overview. This model is built on a sequence of time-based components. Each one has a specific role and set of rules. Here's what they mean. Starting off, what is directional bias? Directional bias is your expectation for where price is likely to go before the New York session open at 9:30. It sets the tone for how you'll interpret the opening range gap and whether you'll look for longs or shorts. Using pre-market highs and lows before 7 a.m. formed between 7 a.m. to 9:30 a.m. So the idea is identify pre-market highs and lows formed within this window. Focus on untapped highs and lows. These act as potential liquidity pools and serve as magnets for a directional bias on price. Price may seek these levels during the New York AM session open, especially if they remain untouched at 9:30 a.m. Okay, so let's get into a quick example. What do I mean by this? Okay, so this is just going over the previous day. We've delineated here 7 o'clock in the morning and here at 9:30. Now in between this, let's say we had a directional bias bearish derived from the higher time frame, okay, which we can go over in a total other video, but that's not the purpose of this video. But let's say we had a directional bias which was short, as I did, and I did post ahead of the time in the Discord. Well, we'll be looking for lows in between this time window. The lowest low forms right here, okay? So this would act as our magnet on price, because from here to here we've formed this high and this low, and then we've just consolidated in here and we never touched this. Okay, now as I said, different video. The reason I'm sure a lot of you thinking, but we never came up here. Well, we swept this buy side, had an SMT anyway. Okay, topic for another discussion. Now going on to the next example of the day before that, we can see again, so obviously bearish example, bullish example, again saying we have a higher time frame bias derived, and on this day it was bullish. We've got our time window from 7 to 9:30, and as we can see, obviously we've dropped down here, created our low down here. Our untapped liquidity is up here at 9:30. We expand higher, okay? So now let's continue on. What is the opening range gap? The opening range gap, also known as the regular trading hours gap, refers to the price difference between the previous day's regular session close, at 4 p.m. Eastern Standard Time, and the current day's open at 9:30 a.m. Eastern Standard Time. This gap can act as a liquidity magnet, a fair value imbalance, or a directional draw depending on market context. How can we use the regular trading hour gap? By marking the previous day's close at 4 p.m. and the previous this should be corrected, and the current day's open at 9:30 a.m. The price difference between these two levels forms the gap, and its equilibrium, also known as the consequent encroachment, is calculated as the midpoint of the gap. These levels act as a magnet on price, and there is approximately a 70% chance that these levels will be filled within the first 30 minutes of the open at 9:30, okay? These levels also help us gauge market sentiment. If price enters the gap but turns away before reaching the midpoint, it shows strength in the original direction. If price closes beyond the midpoint, it suggests weakness and may reduce the reliability of your setup, okay? Premium opening range gap if the market opens higher than the previous day's close. So if the market opens at 9:30, higher than the previous day's close at 4 p.m., creating a gap up, this suggests a bullish sentiment, okay? But this is a premium gap and vice versa, okay? Quickly, this is only an idea though, and the sentiment always doesn't form like this, okay? Rules for the regular trading hour gap: if the gap is greater than 200 or 300 handles, it's considered too large to expect a full fill or midpoint reaction. Expect it to remain totally unfilled. Okay, so we disqualify the regular trading hour gaps that are greater than 200 or 300 handles, okay? So now let's go over regular trading hour gap. Okay, so we can see here on this day, we have, let's mark out our previous day on Wednesday's 4:14 p.m. close. Okay, right, then we'll mark it out regular trading hour gap high. Then let's mark out our open for the following day at 9:30. Okay, right here where this candle begins, because it's a down close candle. Okay, so we have open, high, low, close. Okay, so because the down close candle, that means our open is here. So we'll mark this out regular trading hour gap low. Okay, then we'll grab our Fibonacci and we will measure the high to the low, okay, and we will look for this midpoint. I won't go over this too much, but we can also add quadrant levels and gradient levels to this for, you know, more specific levels. See how we reacted around the upper quadrant level here, etc., etc. Okay, so yeah, we can also see this gap, 74.75 handles. Okay, so it qualifies and is not above 300 handles. All right. Now, okay, moving on, we will go to the first presented fair value gap. Okay, the next criteria in the model. Now, what is the first presented fair value gap? The first presented fair value gap refers to the first imbalance that forms after the market forms at 9:30 a.m. How do we use the first presented fair value gap? Identify the first clean fair value gap that forms after 9:30 a.m. and mark these levels on your chart. Watch how price reacts around these time-based levels, giving insight into the current narrative for the New York morning session. As a general rule, if price is above the first presented fair value gap and using it as support, we are likely in bullish delivery. If price is below the first presented fair value gap and using it as resistance, we're likely in bearish delivery, okay? This gap also acts as a great level for stop placement. If we are bullish and the first presented fair value gap is used for a long entry, your stop placement can comfortably be at the low of the first presented fair value gap. If we are bearish and the first presented fair value gap is used for a short entry, your stop loss can comfortably be at the high of the first presented fair value gap, roughly, okay? Given a couple of handles, whatever, use logical levels, all right? The first presented fair value gap midpoint is an extremely sensitive level and can confirm the order flow without even closing the high or the low. Advanced note, outside of this model, the first presented fair value gap can also be drawn across your chart and used for the entire week to gauge order flow. Okay, we're not going to go over that here though. Rules for the, I would suggest testing this, so it's very valuable. Rules for the first presented fair value gaps: do not use the fair value gap created at 9:30, must be 9:31 a.m. candle and onwards, okay? 9:30 a.m. fair value gaps can be used if price opened above below a liquidity pool on the regular trading hour layout. Okay, I'm not really going to go over this too much in this presentation though. Okay, disqualify micro fair value gaps that are not significant displacements and are below 10 handles in range, just as a general reference. Okay, so now let's go over first presented fair value gap. Okay, honestly, quite simple. As we can see, we've got the 9:30 a.m. open here. We trade lower. Okay, we start trading higher. We trade around here, and we can see nothing's created a gap. Okay, there's no gaps in here. We've got this little volume imbalance, but we're looking for a fair value gap. Okay, nothing qualifies. And then here at 9:34, we have this large displacement higher, which is 10.75 handles. Okay. And you can see here how we use it throughout the lunch session, okay, and even here throughout the PM session, or throughout here, Asia session, the next day's London lunch session, the start of the morning session, and then look right here, Friday 9:30 a.m. On the following morning session, we displace right through it on the 9:30 a.m. candle, use it as resistance and trade lower. And as soon as we get lower, we are in a bearish environment. Okay. Now, putting it all together, okay, so I'm only going to go over one of these here. I'm just going to go over this first one. But I will quickly scroll through and go over the examples. If you want to slow this down or pause this, go for it. Don't worry about this one because I will go over it. But let's start here, okay? So you got bearish continuation setup. If you want to pause these, bearish reversal setup, purge and revert, okay. Got the rest of that down here. Okay, bearish reversal setup, and then chart examples. Okay, so let's just go through these chart examples. Again, pause these if you want, okay? Okay, we're going to be going over this delivery in a different way a little bit today anyway, okay? So now, let's go over the most common form of this setup, right? The bullish continuation setup. Just reverse it for bearish, okay? But the continuation setup. So putting it all together, the opening range plus first presented fair value gap model, okay? Continuation. Used when price is expected to expand in the same direction as the opening gap, okay? Bullish continuation setup. Step 1. Define pre-market liquidity. Mark out untapped pre-market highs at 7 a.m. to 8:30 a.m. These are your buy-side liquidity targets. Step 2, identify the opening range gap. Look for an opening range gap between 9:30 a.m. and the previous close. The gap should be no more than 200 to 300 handles. Wait for price to retrace into this gap during the first 30 minutes, okay, from 9:30 to 10 a.m. Step 3, locate the first presented fair value gap. Identify the first valid fair value gap formed between 9:30 a.m. and 10 a.m. Exclusions. The 9:30 a.m. candle cannot be used unless it opens above liquidity on the regular trading hour chart. Okay, as a beginner, just don't worry about this and just do not use the 9:30 a.m. candle. Okay, disqualify micro gaps when less than 10 handles or lacking clear displacement. Step 4, qualify the setup. Wait for a raid on sell side liquidity that confirms that smart money has cleared opposing stops before shifting direction. Okay, you can look into my ICT core content series on YouTube for this as well, episode 1. Step 5, confirm change in the state of delivery after price reacts to the regular trading hour gap. After the retracement, observe whether it trades above the midpoint or high of the first presented fair value gap. This signals a shift from sell side to buy side delivery. Okay. Step 6, execute the entry. Enter on closure above the midpoint or at most the high of the first presented fair value gap. Step 7, define risk. Place your stop loss a couple handles below the low of the first presented fair value gap. Step 8, set your target. Aim for the pre-market highs in marked in step 1. Okay, so right here I've just given you the entire steps in order and criteria for this model. Okay, so now lastly, let's just quickly go over this chart example. Okay, so give me a second, let me just have some water here. Alright, so we see from here at 7 a.m. to 9:30 a.m. we've got the pre-market highs and lows. Okay, so we've got a bullish bias derived from the higher time frame, and we are then looking for these highs up here. Okay, this is the highest high created within this window, so this is our buy side liquidity. At 9:30 a.m. we open, okay, and we trade high. Sorry, 9:30 a.m. we open and we create this opening range gap, okay, with the high here, the low here, and the midpoint here. Okay, so now what we are waiting for is a retracement down into this gap within the first 30 minutes, okay, which we have right here. Here is our marker for the first 30 minutes, okay, where we touch that low. All right. Now, as we can see, at 9:30 we created this for 9:33 a.m. Sorry, we created this first presented fair value gap. We go above, we use it as support, we trade down below it, okay, and now we've done our retracement into our opening range gap. Okay, all we're looking for now is, well, also we have this stop raid right here, okay, and then price trades higher, and then eventually trading above the first presented fair value gap. Now, once it trades above the first presented fair value gap, this has confirmed to us that the delivery has shifted from a sell program to a buy program. Once it's traded above, we can enter here at the high. Now, I've just added some more like advanced kind of annotations. We have this little fair value gap inside the first presented fair value gap. Okay, so this is a displacement. This price range is inefficient. We would expect price to trade in here. So if you want to refine your levels, rather than entering at the high, you could have waited and entered here on this candle once it taps into this fair value gap. Okay, then the stop loss below the 933 first presented fair value gap. Now, I wouldn't have used the actual low. As you can see, we came down and touched it here, but a couple handles below, you know, because we are trading with this order block here, price came in, wanted to see it sweep this liquidity, tap into here. Okay, so a safe place for the stop loss would be below the mean threshold, the midpoint of this order block right here, this down close candle, because if we are bullish, we don't want to see this down close candle's midpoint be traded through. Okay, but again, that's outside the scope of this model, just adding further details for you guys. So then we can see we trade up here above the high, pre-market highs, and my target is up here. You might be asking, why are you targeting up here? Well, just another advanced note for first presented fair value gaps. We can also grade this first presented fair value gap. Okay, so grabbing the Fibonacci and measuring from its low to its high, and measuring 4 standard deviations. It doesn't need to be 4 standard deviations, but I'm just looking for standard deviations that project above this high. Okay, and then we reach it right here. Okay, so now without all the extra details, what do we have? Okay, just a quick rundown. So getting rid of this and this. Okay, this window here, our time window from 7 to 9:30, we have a bullish bias and we're aiming for these highs. This is the highest high. Okay, at 9:30 a.m. we created a regular trading hour gap and we retraced into it, also creating this first presented fair value gap here. Okay, we swept these stops and then afterwards traded above the first presented fair value gap and shifted to a buy program and entered. okay, in here with that stop loss below the first presented fair value gap, targeting the pre-market highs, okay? So it's really that simple. It's a very simple model. Like I said, great for beginners because everything is static and time-based, so it removes a lot of thinking, you know? But anyways, guys, that's been everything. I hope you guys have enjoyed that. I will continue with the model series as I create more models for you guys. I will first be posting them in the Discord, so if you guys want first access to any of this sort of stuff before I turn it into the videos, then feel free to join that. Link will be in the description, okay? So anyways, take care, guys. I'll speak to you next time. Ciao.